Retail TV is brought to you by founding sponsor Ferris Lee Investments, the largest retail investment advisory firm in the nation. Heslin Becker Properties specializes in the investment and development of retail properties, including ground-up development, distress, and value add. In this segment, CEO Matthew Heslin shares why they're repositioning their asset base and what he sees as challenges to their focus today, adaptive reuse.
We're really focused right now on repositioning our asset base in our portfolio. We're taking advantage of the cap rate environment, the compressed cap rate environment in Southern California, and we're taking those properties and repositioning them into secondary markets where we can get enhanced yields and take advantage of that arbitrage that exists. The repositioning doesn't include repositioning tenants on the existing properties so much as it does disposing of those assets at a very high level price and repositioning it so we can acquire assets outside of the California market where we can get enhanced yields and good credit tenants in those properties. So the arbitrage is explained by getting higher yields on the up leg from the 1031 exchange and lower cost on the debt side. We like the Colorado market, specifically Denver. We like that a lot. We do like, believe it or not, the Phoenix market. We think that there's some great buys out there. If we have the capital to be able to hold those properties and turn those properties into productive assets over time. We are also looking in the Southeast United States and the Miami market in particular. We see some opportunities down there, and we see some opportunities in the Charlotte market. We see some good opportunities in the East Coast as well. Certainly the single tenant assets have been hot. We're recognizing that there is an opportunity to take advantage of the cap rate environment that exists with strong credit retailers on the single tenant side. There's a very strong demand from investors for that product, and we're taking full advantage of that right now. You know, from a development side, I can tell you adaptive reuse is what we're focusing on, taking an asset that perhaps has always been retail, but has outlived its useful life as a retail product, and transitioning that product into medical use as an example. We really see an opportunity for adaptive reuse as a way to enhance yields, as a way to transform properties, blighted properties even perhaps, into a new product type that could be very beneficial for our shareholders. So I would say the lending environment is not conducive necessarily to extensive adaptive reuse projects until you get them over the hurdle of having a vision for the property. And I would definitely say that the environment in the political arena and definitely from an agency standpoint is one of the bigger hurdles. If we're in an environment where we have an older population and it was a retail facility that has an opportunity to become a rehabilitation facility as an example, we see that as a real opportunity. So demographics and consumer demand drives a lot of what we're doing today. Our success strategy going forward is not going to be dissimilar from what it's been in the past, and it served us well. And that is to say, we're not going to over-leverage our properties. We'll put a reasonable amount of debt on the properties, but not a burdensome amount of debt on the properties. We're going to continue to focus on good, solid credit retailers who have a strong business model that's lasting and it's going to be around for 20, 30 plus years. And we're going to continue to do product development in demand cycles where the consumers are in demand of that product. So we're going to focus on those three things. It's what's kept us successful, it's how we weather the downturn, it's how we're going to go forward.
Retail TV is brought to you by founding sponsor Ferris Lee Investments, the largest retail investment advisory firm in the nation.